Hey guys, it's Sebastian from Creator Capitalist. Today we're going to look at why content creators are now starting to angel invest and whether you need to be worried about this as a viewer. Big favor before we dive into all of this though is to give this a thumbs up, and if you're someone that likes stuff like this, consider subscribing. We're focused on the intersect of creators, startups, as well as venture capital. So what's going on? In the past 2 weeks, MrBeast's Knight Media Group, so his management group, just announced a $20 million fund. The Sway Boys, who are some TikTokers, also announced a $15 million venture fund. Lastly, Jake Paul and Jeffrey Wu announced a rolling fund. I can't say too much about getting cancelled, but there's definitely a lot of other content creators that have been angel investing in the last 6 and 12 months. And take a look at the cap table and you recognize certain names, so it's pretty interesting. The reason a lot of this is still not discussed is because there's still a pretty big stigma. It actually reminds me of Generation 1 of YouTube, where being sponsored was considered selling out. So right now we're way past that, we're in Generation 3 or 4 depending on how you look at it, and I would say that being sponsored is actually a good thing. When I see someone like Adam Ragusea being sponsored, it tells me that he made it, and I'm actually happy for him. Angel investing is still in that weird stigma stage, and the reason it's interesting is because content creators are not disclosing it, but they might not need to. We'll talk more about this in the middle and why you might want to be worried. Let's take it a step back and talk about why creators are doing this. One of the huge reasons is due to the lifespan of your average content creator. I would say for most people, you probably have 2 to 3 years of relevance before you fall off the map. There are people like Philly D and PewDiePie who have stayed relevant, but I would argue that's not the normal creator. Even on the main channel Ask Sebi, there's going to be a certain point where I'm not going to be relevant. There's going to be a younger, probably smarter version of me who ends up doing the same thing. One thing I mentioned to a lot of other creators is to focus on building generational wealth. 75% of kids nowadays either want to be content creators or vloggers, so you want to make hay while the sun shines. You have a finite opportunity, so you might as well plant as many seeds as possible, and hopefully this helps you in the long term. The second reason is going to be the shared upside, and brokerages are a pretty good example of this. So with someone like Robinhood, we have referral links and that pays out X dollars. A content creator might push this and the company might be like, hey, we can't pay you as much because we're a relatively small company, we're a startup. So creators still talk about it, they help the company grow, and that $10 million, $100 million company becomes a $1 billion or $10 billion company. Angel investing is interesting because it means that you share that success. The third reason is that creators have an audience, and that oftentimes is a pain point for startups. There's this idea that you can build a great product and that people will come, but that's oftentimes not the case. If you talk to second-time founders, they'll tell you that distribution really matters. I'm going to cherry pick a quote from Justin Kan, who founded Twitch, and he'll tell you exactly the same thing.
First-time founders are obsessed with products. Second-time founders are obsessed with the distribution.
So creators have this audience and they can help you onboard your first 100, 1,000, or maybe 10,000 users. Your product still needs to be competitive though in order to be super successful, but it helps you with that early stage. The other interesting part of it is that when you raise money, oftentimes it's to hire staff to build a product to maintain it or to do user acquisition, so to spend on Facebook and Google ads. Instead of raising from another venture capital firm just to set that money on fire, why not raise a small amount from Jake Paul? And maybe he'll help you with user acquisition. On a side note, if you're someone who is an accredited investor and you're looking for co-investing opportunities, then text dealflow to the number on the screen. I'll try to share some of the creator deals that have a bit of room left over. Back to the video, the big question is, as a viewer, whether you should be worried about this. And I think it's a yes and a no. I think there are some inherent things, but it's really going to come down to the content creators themselves and also their relationship with their audience. There's going to be 2 main issues at play. It's going to be bias as well as disclosures. I'll try to argue both sides of this because I'm literally on the fence. So let's look at potential issue number 1, biases. If a creator invests in something, will that bias their review? On one hand, celebrities have been doing this for ages and they don't have this onus. Ashton Kutcher has a very successful investment firm called A Grade Investments. Investments include Spotify, Uber, Shazam, as well as Airbnb. Jay-Z has a bunch of deals that he's in, and I'm actually in one of them as well, and a lot of them aren't even announced. Nas has Queenbridge Venture Partners, which is one of the most successful firms out there, and he's invested in companies like Dropbox, Casper, and a bunch of other ones. It's also suspected that he got into Coinbase and basically 400x'd his money. So looking at this tweet, if he put in $500,000 into Coinbase, that $500,000 would now be worth $175 million if you factor in some type of dilution. So celebrities can do this and no one really questions it, but on the other hand, are content creators materially different than celebrities? If LeBron James recommends me Beats, I expect it to be an ad. If MKBHD recommends it, then that's more of an endorsement on the quality of the product. This comes down to your relationship with your viewers. For someone like MKBHD, I would trust him to go through the pros and the cons and be transparent with his review. I would not have a problem with him angel investing in the company that he's reviewing because based off the way he does things, based off the way he does reviews, it's very numbers driven, it's very methodical, and I don't think it's going to have a bias. Your focus area is also another one, so people would expect me to have very good reviews of credit cards and stuff like that because that's my niche. Expectations are a lot lower for hardware because that's not really what I'm focused on. So even if I said I really liked a hardware product and it wasn't as good, then people aren't necessarily going to be mad. The type of creator you are also plays a role because if you're someone who is an education or review channel, then there's a higher onus. If you're an entertainment channel, then people don't really care. Let's be honest, is there really any difference between a comedy TikToker or a comedy YouTuber and someone who's a normal celebrity, an actor? I would say not really, it's pretty close. If you move into the middle ground of the Casey Neistats, I think there is a higher expectation due to his experience with tech. The final and potentially bigger piece of this is going to be disclosures, and this gets really interesting. If we go to the FTC, the Federal Trade Commission's main test for this, it's going to be on a material connection. Material being a financial term for substantial. The idea is that if you have a material financial interest, then you need to disclose it. You don't need to disclose the exact terms of the agreement, but that just something there exists. With sponsored posts, it's very obvious. With affiliate links and referral links, it's implicit, but it's also very obvious. If you want to support the channel, then consider using the links down below or the ones on our website, asksebi.com. Being an investor falls into this weird gray area because how much is considered substantial? If me, Kevin, has $500,000 invested in Tesla, does he need to mention that he's an investor every single time he talks about them? What if it was 5 million or 500 million? What's the threshold that we're looking at? If you look at accounting standards, which are a bit different, 1% of equity is considered material. So Tesla is a $600 billion company, 1% would be 6 billion. If I'm an investor in Tesla and I show it in a vlog, does that require me to disclose it? Moving into startups, I would say the average valuation for when creators are really starting to invest is about $20 to $30 million. This tends to be the valuation coming out of a program like Y Combinator. So 1% of 20 million or 30 million is $200,000 or $300,000. For a lot of the content creators that are directly investing, you're looking at $10,000 to maybe $50,000. There probably are people who have $200,000 or $300,000, but I feel like they're investing that in multiple startups rather than a big chunk in one. The thing too is that it's pretty normal to cheerlead the startups that you're invested in. If you go on Twitter, you'll see people like Jason, who's invested in Uber, Calm, as well as Robinhood, cheerlead their startups because that's the expectation. So we talked about direct angel investing, but what if you are someone who has a fund? If I own a fund, generally speaking, you have about 1% of your own money in that fund. So if you're investing in one of these companies, it's never really going to be 1% of my own stake. The math there just doesn't really work out. For Sway, who has a fund, as well as Jake Paul, who has a rolling fund, then arguably, they don't really need to disclose. For something like Night Media, where it's the content creator who has their money, so they're the limited partner there, they also arguably don't need to disclose because they might not even know about it. That's effectively you having money in someone else's fund. You don't necessarily know what they invest in. You might find out every quarter, but there's not really an expectation for you to read through those statements. The same thing with something like Wealthfront or an ETF. You might not know exactly what's going through at every single point. If you wanted to get super into the weeds and super pedantic about it, early stage startups are generally not direct investments in the company. It's either convertible notes or it's safes. The easiest way to think about this is that these are debt notes where you have the right to convert it to equity during the next round of funding. So here's $10,000, it's a convertible note, so you owe me that money, but I have the right to convert it if you can successfully raise a next round. This is pretty normal and standard practice, so at the time of you making that video, you could argue that you weren't an investor yet, you lent them money. For my interpretation, the FTC's priorities are going to be sponsored videos, which is a pretty big one, referral links, and then finally being an investor, which is a tiny thing, and that's ignoring the whole debt side. The thing though with content creators and influencers is that the court of public opinion might be the only one that matters. With all of that said, what are your thoughts here, and when would you expect a creator to disclose that they have a financial interest? Would all the pedantic stuff that we talked about matter or not really at all? Let me know and everyone else know in the comments down below. Big favor is to give this a thumbs up, and if you know anyone else who'd be interested, share this with them, will probably help them out, but otherwise, hope you guys liked it. See you guys next time.